Mr. AG here, Asian guy. And tonight I need to take you through something that has been building beneath the surface of the silver market for months and is now reaching a point where ignoring it is no longer an option. This is not a simple price analysis video. This is not about whether silver goes up 3% or down 3% tomorrow. What I am about to walk you through involves the two most powerful financial forces on the planet, JP Morgan and the People's Bank of China, and the evidence suggesting they are locked in a direct structural confrontation over physical silver that could define where this metal trades for years. I am going to give you every piece of information I have on this, including the pieces that challenge the narrative, because that is what we do here. Both sides, every time, no exceptions. And by the end of this video, you are going to understand the mechanics of what is happening, why the $70 level may now represent a permanent structural floor in silver, and what the COMEX Thanksgiving incident actually tells us about the physical silver supply picture. Let us get into it. Before I start breaking this down, I want to say something to the people who are new here tonight. Welcome. My name is Mr. AG Asian Guy. This channel is MRAG Asian Guy, and that is the only place on YouTube you will find me. I do not sell signals. I do not sell mentorships. I do not sell memberships. I do not sell courses. I do not sell anything. Not now, not ever. If anyone is approaching you and claiming to be me or claiming to be affiliated with this channel and they are asking you for money or offering you any kind of paid service, that is not me. Block them immediately. Protect yourself. I share the raw data. I explain the mechanisms. I give you both sides of every picture, and I let you make your own decisions. That is the entire value proposition of this channel. And based on the messages so many of you have been sending me, this approach is working because you are telling me that you finally feel like you can see through the noise and understand what is actually happening in these markets. That means everything to me. Now let us get serious. I want to start with the structural picture because without understanding the structure of what is happening, the individual data points do not make sense. According to analysis from Lanci, who has been one of the most detailed and data-driven analysts covering precious metals market structure, the silver market is currently witnessing what he describes as a historic tug of war. On one side, you have JP Morgan, and by extension, the US financial system. On the other side, you have China, and by extension, the People's Bank of China. And the battlefield is physical silver, not paper silver, not futures contracts, not ETF shares, physical metal. The kind you can hold, the kind you can deliver, the kind that actually exists in the real world. And the distinction between physical and paper in this context is not a philosophical debate. It is the entire mechanism through which this confrontation is playing out. Let me start with China's position because understanding how they got where they are right now is essential to understanding why the current situation is so significant. According to Lanci's analysis, China once held a very strong bullish position in silver. They were long. They had accumulated substantial reserves and physical holdings. That is consistent with China's broader strategy of accumulating strategic commodities including gold, copper, rare earths, and silver as part of a long-term resource security and currency diversification agenda. But somewhere along the way, according to this analysis, something shifted. China gradually became what Lanci describes as addicted to cheap silver supply. As global silver supplies were available at prices that China considered attractive, they shifted their positioning. Instead of maintaining their long position, they transitioned toward a short position. And not a small short position, a massive one. Now let me explain why that matters in practical terms, because the mechanics here are critical. When you hold a large short position in a commodity, you are essentially betting that prices will go down, or more precisely in the case of a strategic actor like China, you are positioned to benefit from continued availability of cheap supply. As long as global silver supply remains abundant and accessible, a short position allows you to effectively lock in lower prices and maintain downward pressure on the market. The problem arises when the physical supply picture changes, when physical silver becomes scarce, when it becomes difficult to source actual metal for delivery. A large short position transforms from a strategic advantage into an existential vulnerability. Because at some point those short contracts need to be covered, they need to be settled, and settling a short position means buying. If the physical silver is not available in sufficient quantities to cover the short position at reasonable prices, you get what the market calls a short squeeze. Prices spike violently upward as the short seller is forced to buy at whatever price the market demands because they have a contractual obligation to deliver metal they do not have. According to Lanci's framework, this is exactly the vulnerability that JP Morgan identified and has been systematically exploiting. Now let me ask you something before we go further. Where in the world are you watching this from right now? Drop your city or country in the comments below. I am always amazed at how geographically diverse this community is, and knowing where you are helps me understand which markets and time zones are most important to the people who watch this channel. Let me know. And while you are there, tell me this. Have you been following the JP Morgan silver story? Is this new information to you, or have you been tracking it? Drop your answer below. Let us see where the community stands on this. Now let us talk about JP Morgan's side of this equation. According to Lanci's analysis, JP Morgan, which he suggests may be acting under the backing or agreement of U.S. financial officials, has been continuously accumulating and stockpiling physical silver, not paper silver, not futures contracts, physical metal, the kind that sits in vaults, the kind that can be delivered against contracts, the kind that, when removed from the market, reduces the available supply for everyone else. Think about what that strategy accomplishes if you execute it at scale over an extended period of time. Every ounce of physical silver that JP Morgan acquires and warehouses is one less ounce available in the global float. As the available float shrinks, the ability of short sellers, including anyone holding a large short position like the one Lanci attributes to China, to source physical metal to cover their positions becomes progressively harder. The tighter the physical market gets, the more vulnerable those short positions become. And the more vulnerable those short positions become, the greater the potential energy stored up for a violent price move to the upside if and when those shorts are forced to cover. This is not a quick trade. This is not a hedge fund making a 6-month bet. If Lanci's framework is accurate, this is a multi-year strategic accumulation designed to create structural leverage over a geopolitical rival's financial position. The scale of that, if true, is genuinely historic. We are not talking about a market trade. We are talking about a dimension of financial warfare that uses commodity markets as the battlefield. Now I need to take you through the single most compelling and controversial piece of evidence in this entire analysis, the COMEX Thanksgiving incident. Because if you understand what reportedly happened on Thanksgiving at COMEX, you understand why this story has gained so much traction among people who follow silver market structure. According to Lanci's analysis and reporting, JP Morgan unexpectedly withdrew a massive amount of silver from COMEX storage during the Thanksgiving period. The number cited is 13 million ounces. 13 million ounces. Let me put that in context for you. 13 million ounces of silver at current prices around $70 to $75 per ounce represents roughly $900 million to $1 billion worth of physical metal. That is not a rounding error. That is not a routine inventory adjustment. That is a massive, concentrated withdrawal of physical metal from the exchange's registered and eligible inventories. Now here is where the story gets interesting and where the analysis enters territory that requires careful evaluation. At the same time that this large withdrawal is reported to have occurred, the CME exchange, which operates COMEX, reported a cooling system failure, a technical issue at their facility. From Lanci's analytical perspective, this is not a coincidence. He suggests that the timing of the cooling system report, occurring simultaneously with a massive physical withdrawal, raises questions about whether the technical issue was a cover or distraction mechanism designed to obscure or delay the reporting of this enormous asset transfer. Now, I want to be very careful here because this is where analysis can slide into speculation if we are not disciplined. Let me give you both readings of this event because you deserve to hear both. The first reading, the structural manipulation thesis. The cooling system failure was not a random technical event. It was either deliberately triggered or deliberately reported at a specific time to provide cover for the largest single withdrawal of silver from COMEX in recent memory. The withdrawal itself was a strategic move by JP Morgan to remove physical silver from the deliverable supply pool on the exchange, further tightening the available float and increasing pressure on any market participants who need to source physical metal to settle their contracts. Under this reading, the Thanksgiving timing was also deliberate because market participation is at its lowest during the holiday period, meaning fewer eyes watching in real time and less immediate market reaction to the withdrawal. The second reading, the operational explanation. Major banks like JP Morgan regularly withdraw physical metal from COMEX to serve the actual delivery needs of their industrial and institutional customers. 13 million ounces is large but not unprecedented when viewed in the context of JP Morgan's total precious metals operations, which span mining company hedging, industrial customer supply, institutional investment management, and their own proprietary inventory management. The cooling system failure, while coincidentally timed, was a legitimate technical issue at a large industrial facility where cooling systems operate continuously and occasionally fail. Under this reading, the withdrawal is significant market data that tells you about physical demand, but it is not evidence of a coordinated geopolitical operation. Both readings are coherent. Both are supported by elements of the available evidence. The honest position is that without internal communications from JP Morgan, the CME, or US financial officials, we cannot definitively confirm which reading is correct. What we can say is that the physical silver was withdrawn. That is a fact reported in the data. The impact on available supply is real regardless of the motivation behind the withdrawal. And the timing, whether deliberate or coincidental, does raise legitimate questions that deserve transparent answers from the institutions involved. Let me pause here and check in again. How many of you knew about the Thanksgiving COMEX withdrawal before this video? Drop it in the comments. And for those of you who have been following this story, what is your read on the cooling system failure timing, coincidence or cover? I want to hear your perspectives because the conversation in the comments section is one of the most valuable parts of what we build here. Now let us connect this structural analysis to where silver price sits today and why the $70 level has taken on such significance. From these structural dynamics, Lanci presents a price action forecast that is very specific. He asserts that with the physical supply being stockpiled and accumulated by U.S. interests through JP Morgan, and with China potentially being forced to find ways to buy in to cut losses on their short positions, the silver market has fundamentally changed in nature. It is no longer operating under the same supply-demand dynamics that governed pricing even 12 months ago. The physical float has been structurally reduced, the available deliverable supply on exchanges has been drawn down, and the two largest players in the market are positioned on opposite sides of a trade that is becoming increasingly difficult for one of them to sustain. Under this framework, the $70 per ounce level is not just a technical support zone that analysts have identified on charts. It is a structural floor that reflects the actual cost and scarcity of physical silver in a market where the available supply has been materially reduced by JP Morgan's accumulation strategy and by broader industrial and investment demand that has created what the Silver Institute describes as a sixth consecutive annual structural deficit. Lanci asserts that the market will not drop below $70 in any significant time frame in the near future. That is a very specific and very strong claim. And whether or not you agree with the geopolitical framing of the JP Morgan versus China narrative, the underlying physical supply data does support the thesis that the floor for silver prices has moved structurally higher. Now I want to bring in the objective counterarguments because this is where intellectual honesty matters, and this is what separates this channel from channels that just tell you what you want to hear. The story of currency wars and manipulation conspiracies involving major organizations like JP Morgan always generates significant excitement among investors. These narratives are compelling. They provide a framework for understanding market moves that might otherwise seem random or confusing. They create a sense that if you can just see behind the curtain, you can position yourself on the right side of a massive trade. But we need to keep our feet on the ground. Here are the legitimate counterpoints to this narrative that you need to consider before making any decisions based on it. First, the withdrawals. The action of major banks like JP Morgan withdrawing millions of ounces from COMEX regularly occurs to serve the actual delivery needs of industrial customers. Silver is consumed in massive quantities by the solar panel industry, the electronics industry, the medical industry, and dozens of other industrial applications. JP Morgan, as one of the world's largest precious metals dealers, facilitates the physical delivery of metal to these customers as a routine business operation. Not every withdrawal is a geopolitical weapon. Some of them, perhaps most of them, are simply the mechanics of a large commodity dealer fulfilling customer orders. The challenge is that the data does not distinguish between a withdrawal for a routine industrial delivery and a withdrawal for strategic stockpiling purposes. Both look the same in the COMEX reports. Second, China's position. While Lanci's framework describes China as having shifted to a large short position, the actual positioning data from Chinese exchanges and from the People's Bank of China is not fully transparent to Western analysts. Chinese commodity positioning data is reported differently, through different channels, and with different levels of disclosure than U.S. market data. The confidence with which any Western analyst can describe China's exact positioning in silver is inherently limited by the opacity of Chinese financial reporting. The thesis may be directionally correct, meaning China may have shifted to a less bullish or more hedged position without being precisely correct about the size, nature, or vulnerability of that position. Third, the cooling system failure. Industrial facilities the size of COMEX's data and warehouse operations do experience genuine technical failures. Cooling systems in particular are complex, continuously operating mechanical systems that fail with some regularity in large-scale operations. While the timing is noteworthy and worth questioning, treating it as definitive proof of a cover operation requires a standard of evidence that is not met by coincidental timing alone. A genuine investigation by an independent party would be needed to confirm or deny the manipulation thesis. Without that investigation, the cooling system failure remains an open question, not a confirmed answer. These counterpoints do not invalidate the broader analysis. They add nuance and prevent us from treating a compelling narrative as proven fact when elements of it remain unverified. The shortage of physical silver supply and the structural deficit in the market are undeniable facts that are supported by data from the Silver Institute, from dealer reports globally, and from the premium data out of Shanghai and other physical markets. Those facts alone, independent of any J.P. Morgan conspiracy narrative, are sufficient to support the thesis that silver prices have a structurally higher floor than they had even 18 months ago. The geopolitical narrative may or may not be accurate in all its details. The physical supply data is accurate and it points in the same direction. This is the distinction I want you to hold in your mind. You do not need to believe in a coordinated J.P. Morgan versus China silver war to be bullish on silver's long-term supply picture. The fundamental data supports that case on its own merit. The geopolitical narrative, if accurate, would add an additional and powerful layer of support. But the investment case does not depend on the narrative being proven true in every detail. Where are you on this? Comment below right now. Do you believe the J.P. Morgan versus China thesis? Are you skeptical? Are you somewhere in between? And most importantly, does it change how you are positioned in silver? I want to hear from you because this is exactly the kind of question where the diversity of perspectives in this community adds real value. Now let me connect everything we have discussed to the current market picture and what it means for silver in the coming weeks. We are in a moment where multiple forces are converging on the silver market simultaneously. The physical supply picture is tight by any objective measure. Dealers globally have been reporting difficulty sourcing metal. The Silver Institute is forecasting a sixth consecutive annual structural deficit. Shanghai premiums over COMEX have been running at historically elevated levels, which tells you that physical demand in the world's largest consuming market is outpacing what paper prices alone would suggest. CFTC data shows speculative long positions at a 2-year low, meaning the fast money that was chasing silver on the way up to $120 has largely been cleaned out. The remaining market participants are increasingly longer-term holders with stronger conviction. On the other side, CME margin hikes have increased the cost of holding futures positions significantly, from 15% to 18% on silver futures. This has forced and will continue to force the most overleveraged participants out of the market through mechanical liquidation regardless of their directional thesis. Asian markets are still recovering from the Lunar New Year holiday period, meaning one of the most important sources of physical demand has been temporarily absent from the market, amplifying moves in both directions during a thin liquidity environment. The Federal Reserve remains uncertain about its next move. Fed minutes from January show a split committee with some voices advocating for potential rate hikes if inflation stays sticky and others ready to cut if inflation continues to ease. The PCE inflation report, the Fed's preferred inflation gauge, is the next major data point that will help resolve that uncertainty. And geopolitical tensions from Iran to Ukraine to the Middle East more broadly continue to provide a background level of safe haven demand that supports precious metals even during periods of technical selling pressure. Now let me give you the two scenarios clearly because that is what I always do, and it is what you deserve before the next significant move happens. Scenario 1, the bearish case. The J.P. Morgan stockpiling narrative turns out to be overstated. The COMEX withdrawals were routine industrial deliveries, not strategic accumulation. China's short position is smaller or less vulnerable than Lanci's framework suggests. PCE inflation data comes in hot, pushing rate cut expectations further out. The dollar strengthens as a result. Asian demand returning post-Lunar New Year is tepid rather than aggressive. The $70 floor gets tested by another wave of speculative selling and margin-driven liquidation. If $70 breaks with conviction and volume, the technical picture deteriorates significantly, and the 200-day exponential moving average, potentially as low as $50, becomes the next meaningful support level. The structural deficit in physical silver is real but takes longer than expected to translate into price support as paper market dynamics continue to dominate price discovery in the near term. This is the bearish case, and it requires the physical supply thesis to take a backseat to paper market mechanics for an extended period. Scenario 2, the bullish case. The physical supply picture continues to tighten post-Lunar New Year. Asian demand returns with force as Chinese and Indian buyers view $70 to $75 silver as a historic buying opportunity relative to the $120 highs from January. The CFTC data showing speculative longs at a 2-year low marks the capitulation point. Weak hands have been eliminated. The JP Morgan stockpiling, whether geopolitically motivated or driven by industrial client demand, has materially reduced the available float on COMEX. The structural deficit of 67 million ounces forecast by the Silver Institute for 2026 begins to assert itself more forcefully in price as the disconnect between paper and physical pricing becomes unsustainable. The $70 floor holds. Price begins to rebuild above $80 and then toward $90 as the compression between the technical ceiling and floor resolves to the upside. PCE comes in soft, the dollar weakens, rate cut expectations firm up for June, and the macro environment shifts back into a tailwind for precious metals. If the JP Morgan versus China thesis has merit, the squeeze dynamic on China's short position adds fuel to an already fundamentally driven rally. This is the bullish case, and it requires the physical market reality to begin overwhelming paper market mechanics in price discovery. 3 key takeaways, and then we are done. Number 1. The analysis from Vince Lanci presents a framework in which JP Morgan has been systematically accumulating physical silver to drain global liquidity and create structural pressure on China's short position. The Thanksgiving COMEX withdrawal of 13 million ounces and the simultaneous cooling system failure report are the most cited pieces of evidence. Whether this represents a coordinated geopolitical operation or routine industrial activity cannot be definitively confirmed with available public data, but the physical impact on available supply is real either way. 13 million ounces removed is 13 million ounces removed regardless of motivation. Number 2. The $70 floor thesis is supported by structural fundamentals independent of the geopolitical narrative. 6th consecutive annual structural deficit. Dealer sourcing difficulties globally. Historically elevated Shanghai premiums. Speculative longs at a 2-year low suggesting weak hands have been cleared. Margin hikes from 15 to 18% accelerating the clearing process. The market is structurally tighter than it has been in years, and the floor has moved higher as a result. Whether it holds at exactly $70 or slightly above or below that level will be determined by the interplay between physical demand resumption post-Lunar New Year and whatever macro signals emerge from the PCE data and Fed communications in the coming days. Number 3. Intellectual honesty requires acknowledging both the compelling elements of the JP Morgan versus China narrative and the legitimate counterarguments. Major bank withdrawals from COMEX regularly serve routine industrial delivery needs. China's actual positioning is opaque to Western analysts. The cooling system failure may have been coincidental. These counterpoints do not invalidate the broader supply thesis, but they prevent us from treating a compelling narrative as confirmed fact. The investment case for silver does not depend on the geopolitical war thesis being proven true. The fundamental supply deficit data supports it independently. The geopolitical narrative, if accurate, adds an additional powerful layer. Position yourself based on the fundamentals you can verify, not the narratives you cannot. Before you go, I want to hear from you one more time. What is your single biggest takeaway from this video tonight? And where in the world are you watching from? Drop both in the comments right now. The conversation in the comments is one of the most valuable things we build in this community, and I read every single one of them. Your perspectives help shape what I cover next, and they help other members of this community see angles they might have missed. If this kind of analysis is helping you see the complete picture, understand what is happening beneath the surface, and think clearly about both sides of these markets before making decisions, hit subscribe. That is how this community grows, not through hype, not through selling you fear or greed, through showing you the data, the mechanisms, the arguments, and the counter-arguments, and letting you decide for yourself. I will never tell you silver is going to the moon, and I will never tell you it is going to zero. I will give you the raw picture, both sides, every single time. Do your own due diligence. Understand your risk completely before deploying any capital. Be accountable for your own decisions. These markets can be extremely rewarding for prepared and disciplined participants and extremely punishing for those who enter without a plan. Know your time frame. Know your risk tolerance. Know exactly what would need to happen for you to exit your position before you enter it. That is not me being cautious for the sake of it. That is the single most important piece of advice I can give anyone who is watching these markets right now. Invest with logic. Use your brain. Do not follow anyone blindly, including me. Mr. AG out.